Welcome back to another episode of Into Money. I'm Chase Cotnoir with Fidelity. Today I'll be filling in for Jim Armstrong. And with me, as always, is Tony Zhang, the Chief Strategist at OptionsPlay. Tony, it's great to see you once again back here on the program. Now, in preparation for today's show, we've gone through a number of viewer registration questions, and we understand that a lot of people who are watching are looking for the basics, and we see those questions. But we can't always dedicate an entire episode to that. And so what I want to do is just at the top of today's episode, provide some educational resources, and then we'll hop into today's content. What I would encourage anyone who's looking for those fundamentals to search out is fidelity.com/classroom. This will bring you to Fidelity's 4-week online options course made for beginners from Fidelity's trading strategy desk. We had a question from Lewis who was asking, hey, what is the best way to use option features here at Fidelity and their platform? Well, Lewis, that'd be a great place to start. And then we also got another question from Inded who said, hey, how do I better understand the option Greeks? What are those? How can I make that more digestible? Again, I would point you to that fidelity.com/classroom. There's going to be a course coming up on that. These are excellent free resources run here by Fidelity Investments. Now, with that out of the way here, Tony, it's great to see you. Today is Thursday, August 20th. I'm anxious and curious to hear on what are your thoughts of this recent market and what are some things that our option traders should be focusing on today and in the rest of the week.
Yeah, thank you so much, Chase. Not only are you anxious, but the markets are a little anxious. We started off on a much more nervous tone here on the back of some economic data last week that showed that the consumer was potentially slowing. And we know 70% of the US economy is driven by consumer spending. So as the consumer starts to slow down, as consumer sentiment starts to deteriorate, and the housing market starting to show recessionary signs, this is pushing September hike odds down to around 33%, essentially as the economy cools. But despite that, longer dated bonds continue to climb in terms of yields to multi-decades highs. And this is really what the markets were concerned about earlier this week, that required the Treasury to essentially signal that they were going to start supporting the longer dated bond markets, which did calm equity yields or calm the markets a little bit and reduce yields for a single day. However, despite that, some of those gains have already been erased from yesterday's relief rally. You see the 10-year yield pushing back towards 4.7%, the 30-year yield back above 5.25%, which has essentially erased all of yesterday's move. So bottom line, right now, equities are very much focused on the rates market, especially on the longer end of the curve. And this has had a drag on the growth names, the semiconductors, the higher valuation sensitive areas that have been driving this markets higher. If you look at the Qs, the NASDAQ 100 remains significantly under pressure. It has failed to break out above that 730 level and starting to turn lower here. This was definitely the one equity market that hasn't broken out to new all-time highs that we were looking for, that confirmation for the NASDAQ to break out. It has failed that breakout here, and now that starts to put a little bit of pressure here on the overall equity markets. The equal weight S&P 500 has fared a little bit better, showing that the underlying strength of the market is still better than what we're seeing out of the tech-heavy indices. But today's reaction, was fairly across the board. That selling was kind of indiscriminate across the board, which is a little bit more concerning, a lot more defensive in nature from the price action that we saw here today, especially now that essentially you really just have energy that is leading the markets higher, and that's on the back of geopolitical risks out of the Middle East that have driven oil prices higher. You have some select semiconductors that managed to bounce back, but I think those are more short-term bounces on stock that have been severely oversold over the last few weeks. But overall, if you look at small caps, you look at healthcare, you look at retailers, consumer names, high duration growth names, those are all sectors that have started to lag here today. And those are some of the things that are a bit more concerning for the outlook for equities going forward.
Now, Tony, you mentioned the equal weight of the S&P 500. Can you just dive into this a little bit in more detail? I know that there's the S&P 500 index, and then there's the S&P 500 equal weight. What is the difference? I know when I talked to clients back in the day, people would often think that the original or kind of normal, if you will, S&P 500 is equal weighted, but that may not really be the case. Could you just dive into that a little bit more?
Yeah, absolutely. It's actually quite different in nature. You have the S&P 500, traditional S&P 500, which is market cap weighted, which means that each stock's weighting is determined by the size of its market cap versus the equal weight assigns the same weighting to all 500 stocks across the board. And if you look at, let's say, the stock by largest market cap right now, which is Nvidia, that in the market cap indices, that has about a 7.6% weight of the entire index as a single stock versus Nvidia's weight in the equal weight is about 20 basis points. That's about a 38 times higher weighting in the S&P 500 versus the equal weight. If you look at the top 10 stocks in the S&P 500, that has about a 38% weight of the S&P 500 index versus only about a 2.5% in the equal weight. So you have a pretty substantial difference between the influence that the top or the biggest market cap stocks have on the market cap indices versus the equal weight. Technology, for example, accounts for 37% of the market cap indices versus only 14% for equal weight. But ultimately, this all comes down to performance. And in the long run, over the last 10 years or so, you have the S&P 500 outperforming the equal weight by about 3%. The S&P has gone up about 13% per year versus the equal at about 10%. But year to date, as technology has lagged behind, we see the equal weight outperforming the S&P by roughly the same margin so far this year. So it depends on the market conditions that we find ourselves in, and because technology has such a large weight in the S&P 500, it really depends on whether technology is outperforming or underperforming that determines whether the equal weight or the market cap indices outperform. And right now, given technology's weakness, the equal weight is starting to outperform the market cap index.
Got it. That's good context. I always try to remind clients and viewers at home, know what you own, right? You can always take a look at the prospectus, look at the portfolio holdings on fidelity.com, reach out to someone here at Fidelity if you're ever unsure, because again, I've had a lot of conversations, I'm sure you have as well, Tony, with traders who say, hey, I'm in the S&P, it's equal weighted. But usually if we're talking about the standard S&P, as you just broke down, that really isn't the case. Tony, any other thoughts on the macroeconomic setup, or do you want to hop into today's first trade?
Yeah, I have a couple of more thoughts. If you look at Walmart's earnings this morning, it really reiterates some of the concerns that we had last week with regards to the slowing of the consumer. We saw Walmart showing a little bit of a disappointment guidance for the rest of the year. And this is coming in line with Home Depot also expressing some of the concerns earlier this week, especially for the lower income cohort. And this is really what's driving some of the broader market weakness that we're seeing here. In the short term, things are looking a little bit more fragile. The breadth, while remaining relatively constructive, is starting to weaken. And as consumer concerns start to rise, that's really where I think this could start shifting the overall direction for the market, especially as tech continues to weaken. And looking forward, you have Jackson Hole, the keynote next week, which is going to be a major policy test, especially since the new Fed president is has removed forward guidance from his policy. And the other thing to really pay attention to right now is energy. Oil prices continue to rise. We've seen multiple sessions of oil prices continuing to rise on the back of the tensions in the Middle East. And if oil continues to rise, it's going to reverse the disinflation that we've seen here over the last couple of months that have brought down the expectations for September rate hikes. Because if you look at the way yields are moving right now, the bond market is certainly not buying the optimism that the equity markets are currently showing and are expecting that yields are going to have to continue moving higher, which is going to continue to put pressure on technology, the higher duration sectors like the semiconductors and the AI infrastructure trade that have been driving the markets higher here. And that's really why the markets remain under pressure here this week. And I think it's an important metric to pay attention to. Yields, I think, is going to be driving the markets here in the short run.
Got it. Tony, let's go over to your first of the two new trade ideas for today. Now, we got a registration question that came through from Richard that asks, do you ever do sessions specifically on selling vertical credit spreads? And, how do you go about that? What are some of the, best practices or, maybe some rules of thumbs that traders will follow? I thought when I read that question, that kind of teases quite up nicely for the trade that you got here for us today, Tony. Break it down for us. What's this first trade on your mind?
Yeah, the first trade I want to take a look at here is a stock that reflects the shift in market sentiment here right now as investors are more and more concerned about stocks that are high growth, where a lot of the cash flows are discounted far into the future in exchange for stocks that are generating meaningful cash today. And a specific name that has been transitioning between these two phases is Netflix, because over the last decade or so, Netflix has largely been driven off of subscriber growth. But over the last couple of years, they've really transformed themselves away from the growth story into this high margin cash generating media platform. We've seen revenues continue to rise substantially year over year, but more importantly, as they grow revenues, they've continued to expand operating margins and free cash flow. So they've generated $1.5 billion in free cash flow last quarter. Operating margins are now north of 33%, and a full year free cash flow is expected to be nearly $12 billion. So the story of Netflix has substantially changed, but over the last year or so, the stock continues to get punished because the growth story has started to slow down. But I think as investors focus more on cash generation and short-term cash versus long-term growth, stocks like Netflix are starting to show some strength here. And despite today's broad sell-off here, we see Netflix actually holding up relatively well because of this specific mechanism of investors focusing more on short-term cash generation over long-term growth. If you look at the stock here, recently managed to break back above that $80, $77, $78 to $80 zone, which now becomes support. And if it can hold that level, my immediate upside target here is around $95 to the upside and potentially well above $100 to the upside if we can get above that. But this is starting to show a bit of a shift here from what is a clear bearish trend that has been in place that has now bottomed out and potentially starting to outperform here, especially as it broke out above 80 and did so on strong volume and strong relative strength, which is what I'm looking for as a confirmation of that potential breakout. And if you look at the business itself, it's trading at around 20 times forward earnings, which is a discount to the overall industry, despite the fact that EPS and revenue growth are actually faster than the industry. So even though growth is slowing down, it's still growing faster than the overall industry. But more importantly, net profit margins are 28% versus the industry is around 8%. So it's far more profitable. It generates far more cash, yet it trades at a lower valuation while maintaining the same growth profile as the entire industry, which is what makes this such a compelling some people might call it a bottom fishing opportunity on a stock like this that has been beaten up so much over the last couple of years. This is really where I think the upside opportunity starts to look interesting here for Netflix. So the way that I want to play this utilizing options is to go out to the September expiration. I'm looking at selling essentially an at-the-money put, a $79 put earlier today. You can collect about a little over $2.10 for that credit spread, which would give you the obligation to buy the stock at $79 if the stock is below that strike price at that September 18th expiration. And if the put gets put to me at that September 18th expiration, my net effective cost basis of owning the stock is around $76.89, which would be my total risk per share on this particular trade, or $7,689 per contract for each put contract that you sell. But that is going to equate to, in this particular case, about 3% yield that I'm earning on this particular stock over the next 30 days, which is a significant amount of yield to set aside this cash to potentially buy the stock, compared to, let's say, placing a limit order to buy 100 shares of this particular stock.
Yeah, Tony, I look at the registration questions. I'm always curious what people are thinking about when it comes to their strike selection process, or maybe the expiration selection as well. And we had a question that came through from Kenneth that said, "How do I choose the best or the proper strike price?" And I just want to point out, Kenneth, if you're watching here today, that in this case, Tony's looking at it from a technical perspective, or a technical analysis, or charting, and using some of those key levels to help identify a potential opportunity. And Tony, I think our charters and people who like charts definitely appreciate that approach. Let's go ahead and pivot and move on to the second trade of the day. What do you got in your mind?
Yeah, the next trade I want to take a look at here is Northrop Grumman, defense stock in this type of market environment. Looking for more defensive and defense stocks, I think, are interesting opportunities as a intersection in the markets, because Northrop Grumman trades at a discount relative to their defense peers, yet they have one of the strongest backlogs at the moment. They have about $105 billion in backlogs of their revenue, so which makes it incredibly visible out in the next 3-4 years in terms of potential revenue. And they're looking at about $20 billion in net addition to their backlog in just Q2 alone. And this is really the company starting to see defense spending priorities aligned to this particular backlog, and cash flows are continuing to rise. We've seen cash flow continue to grow, and they've raised sales guidance here for 2026 to about $43 to $44 billion, and that's the type of thing that you want to see companies guide higher as they start to bottom out. And if you look at the stock here, the stock has really underperformed quite a bit here this year, but just recently started to break out above that 570 level, which is a major resistance level, and more importantly, it broke out on strong volume while outperforming the S&P 500. So when you see those types of confirmation of a breakout, that's what gives me the confidence that this could potentially continue on towards our first upside target, which is around 625. But our longer term objective on this particular stock is around 690. So significant upside potential here for Northrop Grumman. And a lot of it is rooted in the fundamentals. It's trading at only 19 times forward earnings, while the industry median is around 35, 36 times. And that's really what gives me the belief that there's significant upside potential here, that as the stock price starts to rise, investors are starting to pay attention to this particular stock, especially as geopolitical tensions globally continue to dominate, and defense spending across the globe continues to remain relatively strong, especially with that strong backlog. Revenue visibility is incredibly strong. Growth rates here for this particular stock is a little bit below the industry median. However, profitability is where Northrop Grumman continues to excel relative to the industry, and that's why the fact that it only trades at 19 times forward earnings, nearly a 40% discount to the industry, is what makes this look so attractive from a valuation perspective. So the trade structure that I want to use here is a little different than Netflix, where I'm selling premium to collect income. Here, I'm looking at buying premium. I'm looking at buying that upside potential here, going out to the September expiration. I'm looking at buying the 580 by 625 call vertical. So I'm essentially buying the 580 calls for about $19. I'm looking at selling the 625 calls, which is my upside target, for around a little under $4. So net here, I'm paying about $15 per share for this debit spread, which means that I'm risking $1,500 to potentially make roughly $2,900 on this particular trade, or roughly $3,000, just shy of $3,000 on this debit spread. So giving me a 2-to-1 risk to reward ratio if Northrop Grumman gets up to that 625 level by September 18th, which is roughly, like I said, my upside target, but also the expected move for that September expiration.
Interesting, Tony. So that's an example of opening up a spread. Let's go to a look back, which is here on the show when we review a previous trade from one of our previous episodes. And I think this will help to address a viewer question that we got from Kevin, who asks, when and how do you exit a spread? So I know we just talked about maybe opening up a new one, but Tony, for today's look back, let's talk about closing one, exiting one, or maybe modifying that trade.
Yeah, so a few weeks back, I laid out a bullish thesis on Booking.com as the travel and consumer sector was starting to outperform. And we looked at selling the September 190, 175 put spread. At the time, we sold that for about $5.85. Now, that spread is now trading at only 82 cents, which means that we've made approximately 80% of the maximum profit potential on that particular trade, with still roughly 30 days left to go on this particular trade. So this is a good example where if you've already made such a large percentage of the maximum gain and you still have so much time left in this particular trade, this is a good example where you can start taking profits on this particular trade and look at opportunities of what you can do to adjust that. So first thing I'm going to do is I'm going to look at taking profits, which would have a net gain of about $500 per contract on this particular trade on the September 190, 175 put spread that I sold. And because I still think that there's upside potential here, I'm looking at rolling up the put spread here to the same September expiration and selling the 210, 200 put spread. And earlier today, I can collect another $3.80. So if Booking.com simply stays where it is or continues to move higher from where we are, I can potentially collect another $380 per contract, which shifts my total risk reward on the adjusted trade once you factor into the profits that I made on the first one to now only risking $117 in my worst case scenario. So if Booking.com is below $200, at that September expiration, I'm risking $117. But if it stays above 210, I'm going to make $883, which gives me a nearly 5-to-1 risk to reward ratio. So this is a prime example of where I turned a put spread that originally had a negative risk to reward ratio into a put spread that now has a 5-to-1 risk to reward ratio in my favor by actively managing it before expiration, because I've made 80% of the premium potential in just a couple of weeks since we've entered this trade.
Wonderful, Tony. Well, to summarize here for today, know what you own, obviously, and analyze those opportunities, whether it's through fundamental or in this case, technical analysis in some of these trades. And lastly, manage those trades, right? Manage your risk and opportunities accordingly. Tony, thanks for bringing us your trade ideas this week. It's always great to have you back on the show. And thank you to our viewers for showing up today, spending some of your time with us and asking those registration questions. I always encourage you to leave a question. I actively look through them every single week along with Jim, and so we try our very best to address those questions. And as we wrap up here today, please don't forget to tune in to the Trading Strategy Desk follow-up session that we have tomorrow at Friday at 1:30 p.m. Eastern Standard Time. You can sign up for that by going to fidelity.com/in-the-money-follow-up. And if you're looking for further insights, or you may have missed today's live show, and that's okay, be sure to follow up and sign up for the Active Investor Weekly newsletter. This will send to you highlights of the trades discussed, and you can go there by accessing fidelity.com/active investor weekly.